If you're considering investing in new construction here in the Dallas-Fort Worth area, you've come to the right place. Today we're going to be looking at 6 potential suburbs you could invest in. We'll see what numbers look like on a typical investment property that you could go and find on the market today. Then we're going to look at what's actually happened in each of these markets over the last decade, then use that data to forecast what could happen over the next decade. My name is Michael. I own a local real estate brokerage here in the Dallas area. I've owned 4 rentals myself and fully renovated my last 2 primary residences, and I have a passion for investing in real estate. If you're looking to buy or sell a home in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. The first thing you need to know is that the Dallas market is not a cash flow market, meaning you can't just go put 20% down on any nice new home and expect it to break even. So if you're coming here from somewhere like Bigger Pockets, where they're talking about their $500 a month cash flow on the $90,000 house they bought in Detroit, Dallas is not that market. This video is for people who have a decent amount of cash sitting in the bank and they have plenty of income to sustain a short-term loss, and who understand that Dallas is going to be a high demand market for many years to come, and they want to participate in the gains that will follow. If that sounds like you, this is your video. The first thing you need to know is that if your goal is maximum cash flow, then you're looking for the least desirable homes in the least desirable areas. That's where the most cash flow will always be found. It's why you can find cheap homes in Detroit that will be very cash flow positive out the gate. Well, hundreds of people are not moving to Detroit every day like they are in Dallas. So when you're looking for new construction homes, those are the nicest homes. And then you're looking in a market like Dallas, which is one of the hottest markets in the country, then you're looking for a property that is the complete opposite of what will maximize cash flow. In fact, you might be surprised to find that a lot of investors are buying new construction homes here with 20 to 25% down and taking a very negative cash flow year one. Why in the world would anyone invest in a home to lose money every month? Because they're betting on the future value of not just home appreciation, but also rent appreciation. As you may or may not already know, rents are pennies compared to appreciation. In other words, if you're worried about cash flow in a market like Dallas, then you're simply looking at the wrong number, and I'm going to show you why. Think of it like this. If you were to invest $100,000 in a stock today and then continue committing $400 a month to this stock because you believe in the long run it's going to go up significantly, then you're not really worried about where that stock's going to be next month or even next year, because your time horizon for this investment isn't a year. It's maybe 5 years, maybe 10 years, and you're going to be dollar cost averaging along the way. That's the same concept as buying a rental that's cash flow negative. You're committing $400 a month, knowing that in the long run, that's going to be nothing compared to the appreciation you're going to see. So let's start by looking at some actual numbers. We're first going to look at the average rent appreciation over the last decade, then look at housing appreciation over the last decade. Then we're going to look at what would numbers look like if you were buying a rental today, and then project potential profits moving forward based on the historic data that we have. The 6 markets we're going to look at today are Melissa, Royse City, Van Alstyne, Red Oak, Midlothian, and Forney. Okay, let's start with how I got the following numbers. I looked on the MLS for single-family detached homes that had either leased or sold in December of 2013. Then I compared those to December 2023's number, 10 years later, and I looked at both average and median numbers for all of these, and then I took the lower of the two to make sure that I was being the most conservative that I could. So if the median appreciation was lower than the average, then I would take the median because it's lower. So first up, let's look at a very zoomed out picture, just looking at Dallas and Collin counties as a whole. And then we're going to zoom in on the specific local markets. Looking at Dallas and Collin County combined, on average, rents increased from $1,559 to $2,624 in the last decade, which is a 68.3% gain or 6.83% annual rent appreciation. And remember, this is the lower number of average and median because the median was actually a 71.42% gain. Then I looked at sales prices over the last decade, and I had to separate Dallas and Collin counties for this one. That's the only way the data was available. Looking at Dallas County, the median sales price actually increased 173.2%, although the average sales price only increased 91.16%. Then if we were to look at Collin County, there was a median increase of 98.33%, but an average appreciation of only 87.55. So we could be extra conservative and just take the absolute lowest of all these numbers, which is 87.55. That's 8.8% annual appreciation, taking the most conservative number that we have. So if you're just sitting around at home looking at rentals that you would like to buy in Dallas and Collin County, and you want to forecast these numbers for yourself, you can use these general numbers: home appreciation of 8.8% annual and rent appreciation of 6.83% annual. But now let's start zooming in on these local markets. And I wanted to start with Melissa, Texas today because it's a very desirable market and it's got a lot of investor attention right now, which in general is going to keep rents lower right out the gate. So we're starting with our absolute worst case when it comes to cash flow. This is a very desirable home in a very desirable area. When you compare a market with a lot of new investment like this versus a market like Royse City, which we're about to look at next, in Royse City, investors have already been buying and renting homes out there for many, many years. But this is still new to Melissa, which means you're having a flood of investors right now putting rentals on the market, meaning a high rental supply, which is going to keep rental prices down for now. But as the investment slows down here, as prices continue to increase, then that rental supply will come down and we'll start to see rents climb and see more where it should actually be. Basically, Melissa is a market where there's too much investment happening too quickly to know where rents are actually going to land. If I had to guess, by the time all the investor buying slows down, rents should actually be another $300 to $400 above where they are now. But that's just me speculating from experience. So in a market like Melissa, on the one hand, you have the confidence of knowing a lot of other investors are buying there. But on the other hand, that means you're going to have a lot of rental competition out the gate and you're going to have very negative cash flow. So in Melissa today, and I say today because this is changing every day, but right now I look today, you could find a $400,000 new construction 4-bedroom rental and it would rent for about $2,600 a month. So let's look at the numbers and see what we could expect as a profit for this property. And for all of our examples today, I'm assuming a 25% down payment, a 7.5% mortgage rate, since rates are much worse for investors than they are for primary home buyers, with a $500 annual HOA. And I'm also including taxes in here, and I'm including taxes based on as the home appreciates. So you'll see the mortgage payment goes up over time. That's because I'm accounting for the higher taxes. So this is my spreadsheet. I realize these numbers are too small for you to see, but this is just how my brain works. I just start going and until the spreadsheet's finished, and I don't know how it's going to look, but I'll walk you through the important numbers. So in Melissa, on this 400K home, you would have a 25% down payment of $100,000. Your total monthly payment over here would be about $3,006, and your rents, as I said, would only be about $2,600. So year one, you would be about $406 a month short, but you'd be buying a 4-bedroom new construction home. Everything's under warranty, and it's in a fast-growing area with top-rated schools. According to greatschools.org, all 3 of the schools this home is zoned to are rated a 7 or higher, which is very rare, especially in this price point. Now, using our worst case appreciation numbers in Melissa, over the last decade, we have seen 139% average appreciation. So we're taking that 13.9% average annual. Rents, though, have only seen a 5.51%, and that's for the reason I just discussed earlier. Too many investors buying too quickly here right now. So looking at this chart, you won't break even on rents until about year 8. So you can see years 1 through 7, you took almost a $20,000 loss, but as of year 8, you would have a $432,000 worth of appreciation. Do you now see why investors are willing to buy at negative cash flow today? The cash flow is a small afterthought compared to the appreciation in a prime market like Dallas. By year 10, you finally have a little bit of cash flow. It'd only be about $1,200 a year. And again, I think this is skewed downwards because the rents are being held down by too much investment right now. But either way, eventually you're cash flow positive by year 10, but you would have seen $556,000 in appreciation. And by year 10, this is nearly $1 million house. And before you go thinking, it would be impossible to see this much appreciation. I've watched it happen over the last decade, first in Frisco, then in Prosper. I'm now watching it happen in Salina. And where are the buyers who can't afford Salina buying today? In Melissa. All of those markets have gone from $400,000 homes to over $1 million homes in the last decade. I've watched it happen with my own eyes. So if you're sitting there thinking this is impossible, there's no way, this is the reality of what has happened over the last decade. If you bought a house 10 years ago, this is your reality today. And the same, whoever is willing to buy a house today, this could be your reality in the next 10 years as well. Are there risks? Absolutely. No investment is without risk. But those who took the risk 10 years ago are reaping the massive benefit today. And what you know for sure is if you take no risk today, you are guaranteed you will have no reward 10 years from now. But I agree with you. These numbers sound way too good to be true. So for peace of mind, let's go ultra conservative and let's cut these growth numbers in half. If we cut these same numbers in half, we only have 6.95 annual appreciation and only 2.75 rental appreciation. Year 10, you're still very negative in your cash flow. You're losing $1,800 a year. But even there, you would have made $278,000 in appreciation. So you made $278,000 appreciation, but you lost $1,800 that year in rents. That's still a massive 276% return on your $100,000 of cash. And these numbers also don't account for the amount that the tenant is paying towards your principal, which 10 years on a house like this would probably be another $40,000 that you got from the tenant paying your principal, that I'm not factoring into this. And again, remember, we're taking the lesser of the appreciation numbers and then cutting it in half. And keep in mind, we started out with Melissa as our worst case example. So now let's move on to our next market, which is a tried and true rental market. This is Royse City, Texas. Royse City is 35 minutes directly east of downtown Dallas. It's a very strong rental market and it has low home prices with high rents. So looking at our worst case numbers, we're assuming a 9.05% average appreciation and a 7.81% rental appreciation. Much higher rental appreciation than we saw in Melissa, and I expect Melissa to get to something like this in the years to come. But in Royse City today, I could find you a $350,000 home that's going to rent for about $2,700. This means in Royse City, you could basically break even year one. You would lose $276 for the year, which to me is absolutely a break even. But the bigger story is, look what happens by year 10. You now have $17,743 of annual cash flow on your $87,500 investment, and you've got $316,750 in appreciation. This is a 382% return, cash on cash return, so 38.2% annual return. And this isn't even the best market we're gonna talk about. But again, let's go ultra conservative, cut our appreciation numbers in half. We're looking at year 10, we have 8733 cash flow, and we've made 158,000 in appreciation. That is 190% cash on cash return, so 19% annual cash on cash return. So if these numbers look good to you, call me today and let's go find you a break-even rental in Royse City. I mean, I can find you this exact deal. Now let's move on to our next market. This is gonna be Van Alstyne. This is way up 51 minutes north of downtown Dallas, but it's in Collin County. If you moved here, you'd probably be working in Frisco, McKinney, Allen, somewhere like that. But looking at our worst case numbers over the last decade, forecasting ahead, over the next decade, we're assuming 10.67% appreciation and 9.59% rent appreciation. So you could buy about a $375K home, but rents as of now are still a little low at $2,400 a month. So basically, you're gonna break even on year 3, but look what happens by year 10. You've got $14,540 of cash flow and you've made $400,000 of appreciation. That is a 44.2% annual cash on cash return. Let's go to be ultra conservative. Even being super conservative, you're break even by year 5, but by year 10, you've got $5,332 of cash flow, but of course that's nothing compared to the $200,000 of appreciation that you've gained for a 21.9% annual cash on cash return with our ultra conservative numbers. But let's keep moving on to our next city, and this is actually one of my favorites right now. This is Red Oak, and Red Oak is just 22 minutes south of downtown Dallas. It is the closest in proximity to all the markets we're talking about to downtown Dallas. Looking at our worst case numbers for Red Oak, we have seen an incredible 14.5% annual appreciation and 11.74% rent appreciation. Those are unbelievable growth numbers. You could buy a $450K home today and rent it for about $2,900. This means you're basically break even at year 3, but looking at what happens by year 10, you have $19,223 of cash flow. But even more unbelievable than that, you would have $652,500 in appreciation. This would be a 59.7% annual cash on cash return. But let's go ultra conservative. At 50% of actual appreciation, by year 10, we're at $6,300 annual cash flow and we've made $326,250 for a 29.5, let's call it 30% annual cash on cash return. And again, remember, this does not factor in what the tenant is paying towards your principal. So it's actually even more than this. And I want to reiterate because I know when I'm looking at these numbers too, I think this must be too good to be true. But this is literally what we've all watched happen over the last decade in Frisco, then Prosper, and now Salina. So the same thing that was happening up north there is starting to happen down here in the south. Not just with Red Oak, but my other favorite city to the south right now would be Midlothian, Texas. This is about 30 minutes south of Dallas. And it's pretty similar. Looking at our worst case numbers over the last decade, we had 13.5% average appreciation, 8.84% 24% rent appreciation. You could buy a $435,000 home there and it would already be renting for about $3,300. The rents here are crazy high for the prices. This means you're basically breaking even year one. But look what happens by year 10, $20,611 of cash flow and $587,000 in appreciation for a 55.9% cash on cash return. Unbelievable. But of course, let's go ultra conservative, cut those numbers in half. We would still have $9,861 of cash flow and $294,000 of appreciation for about a 28% cash on cash annual return. And now the last market we're going to look at today, which is not a top pick for me at all, but I get asked about it a lot. This is Forney, Texas. This is just 30 minutes east of downtown Dallas. And looking at our worst case numbers here, we had 9.89% annual appreciation, but only 4.36% rental appreciation. And this is the number that's really going to hold you down. You could today find a $375,000 home that's going to rent for about $2,650. So you can see you're starting with a very small negative cash flow, but even so, because of this low rental appreciation, you're not going to break even until about 6 years. Though it's a very small loss every year as far as losses go. But looking at year 10, you would have $2,538 in cash flow, and you would have $371,000 of appreciation for a 39.8% cash on cash annual return. Then if we go super conservative, by year 10, you are still in the negative only by $120 a year, but you would have seen $185,000 in appreciation for a 19.8% cash on cash annual return. So I know I flew through those numbers. Feel free to watch it again, but in summary, Dallas is not a cash flow market. If you're buying for cash flow here, you're simply looking at the wrong number. And if you're still absolutely convinced that it is a must that you break even year one, then let's go find you a house today in either Royse City or Red Oak. I'm confident that we can find you a break even right now at 25% down. So if you've made it this far in the video, you understand the numbers, you see the value in investing in a high demand market like Dallas, and you just want to hold real estate here for decades to come, call me today and let's get you started on your real estate journey. Please let me know any thoughts or any questions you have down in the comments below. Thank you for watching, and I'll see you in the next video.